All right, good afternoon, good Thursday afternoon, investors and traders and our YouTube audience. I wish it was a better Thursday afternoon, and it seems like the market has a pretty nasty spill when we do the state of the market, which is usually on Thursday. So with that, history's kind of repeating itself. Here we are on Thursday. We had a significant rally to start off the trading session. Unfortunately, that rally has come under pressure. Today is the first day after FOMC day, after the Fed has basically outlined its flexible game plan, right? That's what we'll call it, a flexible game plan going forward. The Fed did a good job of leaving itself in a position where they expressed a lot of optionality. They're going to remain data dependent because this is a very unique situation whereby they're trying to tamp down inflation, but the way that the means for which they have to do so really only impact the demand side of the supply-demand equation. Much of the inflation that we've seen expressed in the economy over the last year and a half, 20 months or so, is not really from the demand side, it's from the supply side. A lot of that is due to, of course, the various COVID variants that have come about over the last 20 months. So with that said, no, I'm not calling for a bear market. Take the graphic just as a means to understand where the bear market levels would come into play. And trust me, folks, if they do come into play, you're going to wish you had cash on the sidelines. All right, with that being said, why is the market failing to hold any types of rallies? Well, there seems to be an excuse every day, but what's taking place is redundant in the sense that it has happened before. Now that the Fed has basically cemented the end of quantitative easing, the end of their asset purchases, the end of QE, the last time that they ended the tapering process, what did we see? Well, we saw the yield curve flatten. Now, after it flattened, it stabilized and then started to steepen again, but that's what's happening here today. What you're looking at now is the spread between the 10-year and the 2-year Treasury yields. This is what is most commonly referred to as the yield curve, and if this inverts as it did in 2019, the recession clock starts to tick. Unfortunately, we didn't really get as high as we did. We didn't steepen the yield curve as much as we did coming out of the great financial crisis. So our starting point for which we're flattening is much lower than the previous post-recession period from the great financial crisis. Right now, coming into today, we only have 72 basis points worth of the Treasury yield spread there. And again, the problem today is we're flattening the yield curve that much more. The 10-year yield is down a little more than 5 basis points. Unfortunately, the 2-year yield is up almost 8 basis points. The 2-year minus the 10-year, that takes us down to about 63 basis points. And people start to pay attention, especially investors in the equity market, right? Because they want to believe that the bond market is sending them a signal, right? It's sending them a signal about the economy. Now, we know that this is not really predicated upon the economy. Heck, we just got fourth quarter first look at GDP, and what did we see? A big beat on GDP, and most people will complain about the aspect of the inventory build contributing to most of that GDP print. You'll never hear them say anything when GDP is artificially low because of a drawdown in inventories, which is why I always say if you smooth it out over time, the inventories just don't really mean that much. It just gives the punditry, it gives the financial media something to criticize. That's what they're best at. So again, today we've got markets under pressure. And here we are. We're pretty much around the lows of the day. We were up 2% at the start of the day and through the first hour of trading. And now all we have to show for it are losses. At the moment, we still have an hour and a half left in the trading day. We have month-end fund flows coming into play, pension funds. They've got to rebalance here at the end of the month. Month-end is actually bigger in terms of flows. Month-end flows are bigger than quarter-end flows. So we'll see what happens here. All right, so these are your bear market levels. It's just good to have an idea of where they are. During this period where we're in a downtrend, and most investors are taking a drawdown. Heck, if you're a long-term investor, you're taking a drawdown right now. It's up to you whether or not you want to take losses. Remember, we're not in a recession. Yield curve's not inverted. Earnings are still growing. Credit spreads are not blowing out. There's nothing really signaling a recession. We just have a market that is trying to price in, what is the appropriate valuation for the S&P 500 now that we're, getting a rate hike regime. We're lifting off, if you will. And we've seen, all different scenarios painted since the 1920s. The growth of a dollar since then, come on. We're hiking rates. Okay, take your drawdown. As an investor's job is not to avoid the pain, but to endure it. How do you endure it? Well, keep your touch points with the market. You can still manage scalp trades here and there because the market is whipsawing quite volatilely. I mean, we have implied volatility going nicely higher, but we also have realized intraday volatility moving nicely higher. I mean, the rotations, the peaks to trough on the intraday are magnificent, offering for a lot of trading opportunities. But again, you got to have the cash on the sidelines. Not every scalp trade is going to work in your favor. Doesn't mean you stop. It means you change your position size. Keep them small. Intraday losses will be small. Intraday gains will be small. You're still keeping your touch points with the market. All right, we've talked a lot about psychology lately and how investors tend to overestimate their concerns, right? The things that plague investors. They're worried about something. The most front of mind thing they're worried about is losing capital. More often than not, the things that we worry about don't come to fruition. And the things that do come to fruition, some 15% of the things that we worry about that come to fruition, we find out that we can easily manage them. What I see a lot of investors do is they seek out answers for problems that don't exist. This table right here comes from this particular study that I found. How you misuse information to overestimate how risky something is. Accessibility. Because you can access the information, if I can recall the information easily, it must be very relevant. That's what we tell ourselves. Recency. If there is recent information, it must be more likely. It's just not the case. Powerful images. If I have a strong image of the thing I think is risky, it must be more likely to happen. Personal relevance. If it's relevant to my plans, it's more likely going to happen. Emotional thinking. If I am anxious, it's more likely. Severity of the outcome. That's where most investors think of the worst case scenario. I think some of this price action recently is the market pricing in some of that worst case scenario. If it could be really awful, then it is more likely. And I think a lot of that recency, issue talked about right here is because we are so close in proximity to the COVID crash. So that's still front of mind with most investors, I would say. Do you really think we're going to have another crash, 1.5 years after the other one? That is so extremely rare. What's happening right now is a normal and to be expected correction because of whatever. I say Fed, you say valuation, somebody else says, well, we simply were due. for a correction. It doesn't matter. They're normal and to be expected. We average one correction a year, at least 10% drawdown a year. Heck, since 1980, the average annual drawdown is 14%. We're not even there yet. Don't lose your minds. Just have a game plan and keep an eye on those buy the dip indicators. All right, we may be down 4 weeks in a row here on the S&P 500. Since 2009, that has only happened, this chart goes back to 2009, it's only happened 9 other times. All except for one closed higher the very next week. Reasons to be optimistic, right? The one failure was 2011. That's this dotted orange line here. That was the one failure. We're looking at this, we're looking at probabilities. What are the probabilities the market will be down a 5th week in a row? 1 out of 9. That is not a high probability we're going to be down next week. In order to avoid a 4-week losing streak, the market needs to get back up to 43.97, which it was earlier today, which it is not right now. We still have another 1.5 hours here and a full trading session tomorrow. All right, the S&P 500 index moves into correction territory. We're not quite there. We were there Monday intraday before that massive intraday reversal. We're not quite there yet. And if we get there, it'll be one of the fastest S&P 500 corrections in history. These are, some of the fastest ones before this year. The S&P 500 index moves into correction. That isn't always bad. What stands out is it happened really fast. These are the number of days it took to get into a correction. But the next 3 months, and that's what I want to focus on here, folks. I didn't say the next day, the next week, 2 weeks out. The next 3 months, the S&P 500 was up 7.5%. When you had this kind of rapid correction, it was up 100% of the time. Not on the year, that's not what I said. It may not make a new all-time high, but it was higher than that 10% level that it took to get down to. 6 months later, again, it's up 100% of the time. The average return, 14.7%. What I'm saying here is don't lose your touch points with the market. You gotta stay engaged. I know the price action sucks. I know you're looking at gains for last year and you're saying, man, I've already lost 10%, 15%, maybe 20% of the gains from last year, or at least I'm taking a drawdown of that much. I know that's not always appetizing. But the cash on the sidelines, remember, layer in a little bit at a time. When the market does revert to that uptrend, you're starting with those positions at maybe it was 5% drawdown on the S&P 500, 5%, then 10%. You're starting from there. And the market's going to rally maybe 7.5% on average, 14.7% 6 months out, which takes us basically to July. Stay engaged, folks. Stocks tend to do well after corrections. 1 year returns after the correction low. And you notice this, there's some big, corrections in here. 1987, of course, right there, 2020. But 1 year returns after the lows, 90% higher, folks. Look at that, 24.8% average return. The median is even higher. Don't lose your grip. Just move your time horizons. Extend your time horizons. Again, I empathize. I know this isn't the funnest way to start a new year, but it happens. We did talk about expecting more volatility in the new year, simply because we were coming off a low volatility regime. Usually you have a higher volatility regime in the next year, especially given monetary policy adjusting. one of the other things I want to say is that the rapidity for which we're getting this correction, many stocks are in bear market territory. That sets the stage for a really strong breath thrust. The faster you go down and the faster you snap back, you get these really nice breath thrusts. Think about 2018, Q4 of 2018, right? We had a 3-month decline into a technical bear market. On a closing basis, it was 19% plus. And what happened is that we lit a match and basically watched the market take off into 2019. And we got what's known as a Zwig breath thrust. And this study right here tells you the forward returns after you fire a Zwig breath thrust. So check it out. So there is always something good to come out of bad price action. You just got to stick with the market, stick to your disciplines. Excuse me. I'm still fighting a cold. I apologize, folks. All right. What happens when the S&P 500 percentage of 2163 in 250-day lows exceed similar threshold levels to Monday's session? Monday's session, 2163 and 250-day lows got up to this particular level signaled by the sentiment trader. This signal has triggered 50 other times over the past 94 years. After the other times we got to this level, S&P 500 futures returns were positive across all time frames, with the best risk-reward profiles coming in the 2 to 6 month time frame. Not the 1 week, not the 2 week, not the 1 month, going further out, which tells you we may muddle through the first quarter of this year, which pretty much lines up with the midterm election cycle composite index, as well as the decennial year composite index model. In our weekly research report, we talked about the VIX. We talked about the rate of change, using the 10-day rate of change for the VIX, getting up to this 50 level. It basically suggests that the S&P 500 is getting oversold. The hedging activity is overdone. Doesn't mean it can't go a little higher, and it certainly has gone higher here, to end last week and into today. But this is usually part of that bottoming process. We can't pinpoint the bottom, but we know that all of the factors are coming into place. All of the variables are being highlighted so far as the bottoming process. Just like topping is a process, so is bottoming. Don't try to pick bottoms. Just stick to your game plan. Monitor those oversold conditions and stick to trading, because we are below the 200-day moving average, and a lot of volatility tends to arrive when the indexes are below their 200-day moving average. The VIX is also, as of yesterday, up 7 days in a row. That's the first time since the 2016 election. There are 12 prior instances that the VIX was up 7 days in a row, 12. Of those 12 times, 9 reversed the next day. 3 made it to 8 days in a row, and 1 of the 3 made it to 9 days in a row. Chronologically, the first 9, right, the ones that reversed the next day, happened between 1990 and 2011. All those stopped at 7. And it was just the last 3 that kept going. But 9 days in a row is the most. So again, we're looking for data that supports the bottoming process is afoot. Here's what happens now after the VIX is up 7 days in a row. What are the S&P 500 forward returns? The 1-day return is 66% of the time it's positive. I mean, that's better than 50-50. Small, not 0.91% average return. Things get better though. The 2-day return. The 3-day return, 83% positivity rate, bigger gains. 4-day return, 75% of the time positive. Again, good gains here. Essentially, again, in the bottoming process and getting some mean reversion in the VIX, and folks coming in to buy value. Now it's day 8 and the VIX is up right now. We'll see what happens by the end of the session and, of course, tomorrow, the end of the week. What else? Well, the DIX. The DIX is the aggregated dark pool indicator of the S&P 500, DIX. Okay, it's something that has been made popular by Squeeze Metrics. And it basically tells you that there are buyers underneath the surface. While selling action has been robust, there has been ample buying that is picked up by the dark pool indicators. So when the dark pool is high, as it is here, it's above 50%. That is a very high number, folks. Doesn't get much higher than that. So here's the forward S&P 500 returns when the DIX prints greater than 50, as it did yesterday. You see a lot of green on that. Let's just leave it at that. You see a lot of green on the screen. It hasn't happened many times. It's only happened 7 times prior to yesterday. Since 2015. That's it. Most of the forward returns are very positive. A lot of this happened in 2020. A lot of it happened in 2020. This is the first time since 2020 that's happened. All right, as I said, S&P 500 is below the 200-day moving average. Since 1990, the S&P 500 broke below its 200-day trend line 34 times. So that's happened 34 times since 1990 after standing above it for at least 20 days. That's what I want to see. We want to see what are the forward S&P 500 returns when we break below the 200-day moving average, but we've been above it for at least 20 days. The 1-month return, and again, it's happened 34 times. The 1-month average return, 1.8%. The percent positivity rate is very good, 74% of the time positive. 3-month return, returns get bigger. Percent positivity rate increases the further we go out in time. And all of these, the average return is better than the average return of any other time period since 1990. Pick something, pick any parameter you want. Once we break below the 200-day moving average, generally the 1, 3, 6, and 12-month returns are better than any returns over any time period since 1990. So again, you'll get the volatility below the 200-day moving average, but usually it's a good buying opportunity, assuming we're not going into a recession. All right, one of the things that I've been focusing on lately, because there are so many similarities between 1982 and 2022, is the S&P 500 analog. And wouldn't you know it, the S&P 500 dropped almost 7% at the very beginning of 1982. And it was down for the month of January. The toy barometer fired bearish in 1982 as it did this year. It's a decennial year because it ends in 2. It was after a recession. And during 1982, the first quarter of that year, the Fed hiked rates 3 times. Going into the very last 2 trading days of January in 1982, the market snapped back, but then it rolled over again the first trading day of February and kept going down into March, as you can see here. That's why I say use any opportunity here in the market to rebalance to the upside. When the market has a good day, maybe you bought the dip the prior day, use that as a means for extrapolating your scalp profit and or rebalancing your portfolio in favor of your risk appetite. Let's call it your risk tolerance, because we could have more downside. Now, after Q1, we had a really nice rally into mid-May. So we'll see what happens, folks. But right now, there's so many similarities. See if we get that snapback rally here maybe tomorrow. All right, the Nasdaq Composite closed higher after 4% intraday drop on Monday. 1 day later, 60%. 1 week later, not so good. You have an average negative return. 1 month later, not good. 3 months later. Now, this is a really obscure statistic, right? You drop 4% intraday, and then the NASDAQ rallied positive, and our sample size 1, 2, 3, 4, 5. That's not enough. Remember, baseline is 6 for a sample size. Really just putting in this in here because, again, it's a really obscure data point, and we don't even have enough sample size to really qualify for probability's sake. All right, the percent of NASDAQ stocks at 52-week lows, 30+%. It's a lot. To not be in a recession or a threat of a recession, even near term. And despite Monday's reversal, many more stocks on the NASDAQ exchange touched a 52-week low during the day. More than 30% of stocks on the exchange plunged to that extreme on the same day. That's the 18th highest figure since 1996. Even though this was exceeded before the final plunges in 2008 and 2020, the Nasdaq Composite's forward returns were quite impressive. Over the next year, the Nasdaq showed a gain all 17 times that it reached this level of the percentage of stocks at 52-week lows. 100% of the times this has happened since 1996, the Nasdaq was higher a year later. Glass half full, folks. Here's the Nasdaq now, right? I mean, we're pretty good. This is the 50-day moving average. We are a pretty good distance from that 50-day moving average. Most of you have heard me say before, when you get all this white space above the 50-day moving average, white space above, white space above, white space above, you get some mean reversion. You get profit taking. It's just human behavior. Well, when we're this far, we're like 3.3 standard deviations below the 50-day moving average. What do you think happens so far as human behavior when you've had this degree of a sell-off to where you're 3+ standard deviations away from the 50-day moving average? If you get profit taking here, you probably get dip buying here. According to Bespoke Investment Group, since the end of the global financial crisis, the NASDAQ closed more than 3 standard deviations below the 50 DMA 9 separate times. Performance was mixed over the subsequent few months. However, 9 out of 9 positive returns 6 to 12 months later. So we could muddle around here for a while. The same as in the S&P 500, could see the same in the NASDAQ. More than 85% of NASDAQ 100 stocks are now in a correction. This is a level of wipeout that has literally led to a rebound 100% of the time. You have to kind of ignore 2000 to 2002 and 2008. But you can see 1 week later, because this is going to be down 5 weeks in a row for the NASDAQ if we finish lower. But 1 week later, 85% of NASDAQ 100 stocks in a correction. Win percentage, 78%. 2 weeks later, 1 month later, 2 months later. Got a lot of strong probabilities, folks. When I say that we've been oversold, we've stayed oversold longer than most people think. But there's opportunity for at least a reflexive rebound in the near term. For you bubble aficionados, who are looking at this chart of the NASDAQ and saying, wow, this looks like 1998 to 2000 all over again. not quite the case. The chart above shows 5 data points related to the Nasdaq meltdown, and eventually recovery from 1998 to 2003. 1998, the peak to trough, the Nasdaq, well, from 1998 to 2000 and then 2002, we had a 78% decline over 19 months. Now the initial plunge, all right, the first pullback was from the March 10th highs, 36%, dropped 36%. Folks, we're down about 17% on the NASDAQ, maybe 18%. Could it get worse? Clearly. But it's not down 36%. Don't jump to the whole, this is the dot-com bubble thing all over again. Because more than likely, it's not. And what is our sample size when we talk about the dot-com bubble? That's right, 1. So check out a lot of the notes in here. Refer to the chart. It'll alleviate some of that concern. And if you still have concern over the geopolitical issues that are still playing out, i.e. Ukraine, Russia, NATO, past geopolitical events, this is what we're looking at. Bombing in Syria, North Korea missiles, 6-Day War going all the way back to 1960s, the Suez Crisis in the 1950s, the Madrid bombing in 2004. U.S. pulls out of Afghanistan last year. S&P 500 returns in total drawdowns. Here's the drawdown, the biggest, or the average drawdown, 4.6%. The average drawdown. Bottoms averaged 19 days, which is almost a calendar month of trading. Recovery time period, 43 days, 2 months. They're not that bad. They're just not as bad as these crash scenarios that people like to promote. Stay nimble, stay disciplined, cash on the sidelines, folks. You remember what happens come July in a midterm year and how the market performs from November of the current midterm year to April of the following year. The market has been up 100% of the time, going all the way back to the 1930s. The average return over that November midterm year to the next April is 17.2%. Stay disciplined. Keep your wits about you. Take your drawdowns like big boys and girls. Take your shots here and there at the market. Look for those trading opportunities and be in touch. Your resources are here to help guide you through these situations in the market where the headlines are all the craze. It's fear and loathing out there right now. Don't let it grip you. With that, I'm Seth Golden, and we'll see you here next time on our State of the Market.